My name is Jake, welcome to the channel. In today's video, we're going to talk about how to invest based off of your time horizon. One of the most challenging things when it comes to dividend investing is starting. In this video, I'm going to break down 4 different portfolios based off of a time horizon of 10 years, 20 years, 30 years, and 40 years. My channel is all about thinking differently. This video is about investing based off of your time horizon. So it doesn't matter if you're in your 20s, your 40s, or if you're 16 or 18 years old. This video is structured to help you think in a different way, not based off of, okay, I'm 20 years old, what do I need to invest to be a millionaire at 60? But rather, when do I want to live off of the dividend cash flow, the dividend income from my portfolio? That's the question that I want to help you understand and help you answer throughout this video. I guess you could say this is kind of like a dividend starter pack. I'm going to share some things that you need to know if you're first starting out and some things to look out for when you're building your portfolio, especially for the first time. So welcome everybody to your dividend starter pack. But first, if you're new to the channel, my wife and I, we're down here in Austin, Texas. We're in our mid-30s and we're looking to retire in our mid-40s. I created this channel to help inspire and educate new or beginner investors. Before we dive into today's video, let's hear a quick word from our sponsor.
Today's video is sponsored by life insurance. Get your new life insurance today at... No, I'm just kidding. But if you do want to support the channel, I have just the thing for you. Hi, I'm Jake's wife, and today I want you to show some of the cool dividend merch that we've created. You can choose from different designs, colors, and styles for you, your partner, or even your little furry one. We invite you to check it out and stay tuned for future designs. Thank you so much for supporting the channel.
It's not life insurance, it's just dividend merch. If you do want to support the channel, you can check out the link in the description below, and really appreciate it if you want to support the channel. Before we dive into the 4 portfolios here, I want to take just a second and I want to share some of the thought process that I had when creating this portfolio and why I made a few of the decisions that I made. This portfolio here that I share on YouTube, and the link's in the description if you want to check out the pie, I created this in mind to generate cash flow or dividend income in a 10-year time horizon. Because my wife and I are looking to retire in 10 years, we need a higher starting yield. A lot of you that are following the channel are maybe in your 20s. If you're in your 20s and your time horizon is 20 years, 30 years, the investments or the allocation is going to look different. So when you're seeing a portfolio like this, you have to ask the question, is this the right approach for you, or is it going to look something differently? I think asking questions is really what's going to help you the most. When I first started investing and learning about dividend investing, I was absorbing and consuming as much information as I could. I was asking questions left and right. And that's one of the great things that I love about this YouTube channel is I get to interact with all of you. A lot of you are asking great questions when it comes to your own portfolios. You're asking about the investments that you're investing in. It is so great to see that so many people are asking so many great questions. It kind of feels like this for me when I get all of your questions.
Holy smokes! Oh my God! Yes! 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 I'm wall-to-wall raccoons.
My portfolio has 50 holdings. Not all of the holdings in my portfolio hold the same weighting or the same value. The top holdings in my portfolio make up my core holdings. My core holdings are the positions that I'm betting on or banking on the most to fund my living expenses in early retirement. My core holdings consist of companies or investments like 3M, Coca-Cola, Pepsi, and also dividend growth ETFs like SCHD, VYM, and DGRO. In addition to my core holdings that I have in my portfolio, I also have additional holdings in my portfolio. The core holdings in my portfolio make up the majority of the portfolio. The goal for this portfolio is to have a 3.5% of a current dividend yield. The goal for the dividend growth is around 8%. Those are merely goals. They're kind of a moving target, but those are the goals that I have for this dividend portfolio. Let's now take a look at the 4 different portfolios based off of a 10, 20, 30, and 40-year time horizon. The first portfolio that we're going to take a look at is based off of a 10-year time horizon. This portfolio is going to target a 3 to 4%. So if you're looking to retire in 10 years, this portfolio is a portfolio that you could take a look at and build off of. Now, it's important to note a few things that we're going to take a look at here. So once again, the target is a 3 to 4% dividend yield. Over the last 5 years, this portfolio has gained over 30%, not including the reinvestment of dividends. This portfolio, like the others that we're going to talk about, all have 10 total holdings. The dividend yield for this portfolio is just under 3.5%, and it has a low expense ratio. And the average dividend growth rate for this portfolio, or the target, is about 7 or 8%. So when you're building a portfolio with a 10-year time horizon, these are the metrics that I like to look at. A dividend yield between 3 and 4%, a current yield, and a dividend growth rate between 7 and 8%. Anything above that is icing on the cake. So let's take a look at the investments that we have here. We have 10 holdings, and we have 3 ETFs and 7 individual holdings. In this portfolio, we have SCHD as a high dividend ETF from Schwab. We have VYM, it's a high dividend ETF from Vanguard, and VNQ, it's a high dividend REIT ETF from Vanguard. In addition to those, we also have 3M, Coca-Cola, the Southern Company, Verizon, Duke, Kimberly-Clark, and Public Storage. Now, for example, let's say you wanted to start a dividend growth portfolio and your time horizon that you've decided is 10 years. This is a great portfolio that you could build off of. Now, obviously you can plus or minus the different holdings in here, but this is an example of a dividend portfolio with that time horizon of 10 years. Now let's take a look at the next one here for 20 years. The Dividend Starter Pack for 20 years, what we're targeting here is a 2 to 3% of a current dividend yield. The CAGR, or the compounding annual growth rate, the growth of the dividend, not the capital appreciation, just the dividend, we're targeting right between 8 and 10%. As you can see here, the 5-year return is higher than the 10-year because it's more focused around growth. So the 5-year return on this is 63%, not including the reinvestment of dividends. Also, this portfolio has 10 holdings. It has a 2.5 starting yield, and it has a small expense ratio. The holdings in this portfolio that we're going to take a look at, we have 3 ETFs like the last one, the first being DGRO, SCHD, and VTV. These are great dividend growth ETFs. In my opinion, there's a great balance between growth and current income. And so once again, we're targeting that 2 to 3% range. And the individual holdings, a few examples that I like from different industries. You have, for example, Johnson & Johnson, you have Lockheed Martin, you have others like Pepsi and Procter & Gamble. And the cool thing here is if you wanted to take a look at different companies based off of your time horizon, there's a few here from each individual industry. We got a utility, we got healthcare, we got industrials, consumer discretionary, consumer goods, etc. So really, really good, well-balanced portfolio. So when we compare this portfolio with the last portfolio, you can see that there's more growth in this portfolio than the last portfolio. The last portfolio, it had, Coca-Cola. In this portfolio, we have Pepsi. Pepsi is growing faster than Coca-Cola. However, Coca-Cola has a higher starting yield. And so there's kind of that trade-off of, growth versus income. And this portfolio, in my opinion, is a good balance. And if you're building out a portfolio with a 20-year time horizon, this is definitely a portfolio that you could take a look at and build off of. The third portfolio that we're going to take a look here is with a 30-year time horizon. So with this portfolio, what we're targeting, or what I kind of like to say is the sweet spot for the dividend yield, the current yield, is 1.5 to 2.5% for 30 years. Over the last 5 years, this portfolio is up just under 90%. Once again, not including the reinvestment of dividends. If you look down here, it has a little bit of a higher expense ratio. It has just under a 2% dividend yield and 10 holdings. So what do we have in this portfolio? In this portfolio, we have DGRO, we have VTI, and DGRW. So DGRO, we've seen that one a few times. It's also in my portfolio. VTI is the total stock market, and DGRW is great. It's a great dividend growth ETF focused on future growth. And so the holdings in here are going to look quite differently than the 10-year time horizon. For example, when you look at the holdings in here, you got, for example, Waste Management, Target, NextEra Energy. And so this is something that I want to highlight. When you look at NextEra Energy and you compare NextEra Energy compared to Duke or Southern Company, they're all utility companies. NextEra Energy has a much lower starting yield than Southern Company. They're both utilities. One has a higher starting yield and is growing slower. NextEra Energy has a lower starting yield, but is growing exponentially faster. And so over the time frame that we're talking here, we're talking 30 years, NextEra Energy is going to be able to compound and grow exponentially faster given the time horizon. We also have other high growth companies in here, for example, with American Tower. We also have Honeywell and Air Products and Chemicals. These are great companies. If I look at this portfolio here, every single holding here is in my portfolio with the exception of DGRW. I do not have that in my dividend growth portfolio. VTI, I have in my Roth IRA. So the majority of these, they're in my portfolio as well, but they make a very small percentage of my overall portfolio. Like I said, if I was in my 20s and I had a 20 or 30-year time horizon, I would be loading up the truck with Waste Management. I just absolutely love it. I mean, for me, it's like a clear winner. But with the others in my portfolio, given my time horizon, I've adjusted the allocation accordingly. Now let's take a look at the fourth portfolio for 40 years. For 40 years, what I like to target, if an individual has 40 years of compounding ahead of them, I think a target starting yield of 0.5% all the way up to 1.5% is a good target. And when it comes to the dividend, the compounding annual growth rate, I would say anything over 10% on an annual basis, year over year, 10%. And as well as also for the 30 year. The 30 year and the 40 year, I think the sweet spot is a 10% CAGR, compounded annual growth rate. For this portfolio, it's up 173% over the last 5 years, not including the reinvestment of dividends. The portfolio has 10 holdings. It's just under a 1% dividend yield, and it has a low expense ratio. In this portfolio, we have it focused more around growth. The first ETF is SPYG. This is the Spider S&P 500 Growth ETF. Really great ETF. The next one is VGT. VGT I have in my Roth IRA. I do not own SPYG personally. When I have kids down the road, that will be a holding that I put in a custodial account, for example. With VTI, this is the total stock market. It's, it kind of, when I was preparing for this video, it kind of came as a shock for me. This was one of the more difficult ones for me to determine whether to put it in or to take it out. Just given the historical performance, the annual growth rate and everything, it checks off all the boxes. And given the unknown, nobody really knows what's going to happen in 40 years. 40 years is a hell of a long time. And having the total US stock market in there is, in my opinion, a great choice. Also looking at it from an individual company side of things, you're going to see companies like Apple, Microsoft, Visa, Costco, Nike, these really hyper growth companies. In some cases, some of these companies are growing their dividend 10, 15, 20% year over year. Now you have to also factor in and understand a lot of these have less than 0.5%, or some of them have a very small starting dividend yield. And if you look just at 2020, if you look at the growth rates of 2020, it's a little bit challenging because the economy is facing a little bit more, uncertainty. But if you go back 10, 20 years, you can see that historical return. And as we all know, historical returns are no guarantee of future returns. But this, when we're looking forward and we're projecting for the future, that's typically the gauge or the metric that we're looking at. So when we look at this and we put this all together, we can see that if you're investing for dividend growth, and you don't plan on selling your shares, it really comes down to your time horizon. If you have a 10-year time horizon, your focus should be on current yield, but you also don't want to sacrifice growth. Because we have that thing, that silent killer in inflation, you want to make sure that the investments that you're investing in are still growing on an annual basis. If you have 40 years to go, and now this is not, based off of age, like you could be in your 20s, you could be in your 30s with a 40-year time horizon. Generally, you'd probably on the earlier age of maybe 18, 20, etc. if you had a 40-year time horizon. But the important thing to note here is this would be a great starting point for a new investor with this particular time horizon. So when you're building out your portfolio, it's important to understand what is your goal, what is your time horizon, and then work from there. If you know that you have a 10-year time horizon, you need to construct your portfolio in a way so that it meets your goals. You don't want to be investing into pure technology, pure growth, if you're looking to live off of the dividends in your portfolio. And now, very, very important, this is off of the assumption that you're not going to sell your shares. If you don't plan on selling your shares, liquidating them, and then to purchase other shares, this is under the assumption that you're never going to sell your shares and that they're going to grow and they're going to compound. So if we were to recap this really quick, when you're building out your portfolio, if you have a 10-year time horizon, you want to look for a 3 to 4% current yield. I find that this is really the sweet spot. Also, when it comes to the growth rate, the compounded annual growth rate, this is just the dividend, you want to look for right around a 7% annual growth rate of the dividend. When it comes to 20 years, the sweet spot, in my opinion, is a current yield of 2 to 3%, with a CAGR, compounded annual growth rate, of around 8 to 10%. That should be your core holdings in those ranges. If you have 30 years, in my opinion, the sweet spot is 1.5 to 2.5% of a current yield, with a compounding annual growth rate of the dividend of 10% or more. And then if you have 40 years, this would be a great one if, for example, if you had a Roth IRA or a tax sheltered account, for example. The sweet spot, in my opinion, is a 0.5% all the way up to 1.5%, with a compounding annual growth rate of the dividend of 10% or more. When constructing my portfolio, it really helped to first understand and answer the question, when do I want to retire? When is my time horizon? And if you don't know, I would encourage you to side more on the side of growth and be a little bit more conservative. Sometimes we can get a little ahead of ourselves and get a little bit optimistic. And I believe being a little bit conservative in our planning is never a bad idea. So when you're planning your future, if you have aspirations to reach this goal of early retirement or live off of your dividends, try to keep it on the conservative side. That way you don't run into any surprises or anything like that. That's been my personal experience. So once you've identified and decided your time horizon, then you can work backwards and construct your portfolio so that it meets your goals. Thank you so much, everybody, for watching the video. If you're new to the channel, I'd invite you to subscribe. If you want to support the channel, check out the merch link in the description below. If you liked today's video, give me a thumbs up, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.